So, before we get to any other topic on this program, this is one of those shows where we just got to get straight into it. The week that was obviously was a rough week for the markets as the story about the coronavirus continued to spread. We'll have a lot of thoughts on that today on the program. And then I assume we'll have time, although we may spend a lot of time talking about this virus stuff. At some point, we'll shift gears. We'll talk about sort of who won, who lost under the tax cuts of a couple of years ago. Have seen a full tax year on that, now in the middle of a second tax year. And so the winners and the losers on that are starting to show themselves. So we'll cover that on the program. Of course, this is Dollars and Cents. We are Central Florida's longest running radio program. Made it through the SARS epidemic, made it through Ebola, made it through Zika. I think we'll make it through coronavirus. My name is Joel Garris of Nelson Financial Planning, and you're listening to News Radio WFLA in Orlando. If you're catching us on the internet, chances are you're on one of our many social media channels. So make sure you subscribe to us if you're not a subscriber on anything ranging from iTunes to Google Play to Facebook to YouTube. That's where we put up the videos that we shoot on the program as well. Recently named one of the top 25 financial planning podcasts on the World Wide Web. We're glad you joined us, particularly on a day like today after the week that was. We sent a communication out to all of our clients on Wednesday. We'll share a lot of what we said in that communication on Wednesday to our clients, and to help, I guess, provide some perspective to this. This, in our opinion, is a classic situation of taking a story, making a mountain out of a molehill. But the problem is that sometimes when that happens, it can have far-reaching expansion. And particularly with the response and the reaction that's happening in China, that's now sort of spreading just as the virus is throughout the rest of the world, you're seeing the effects of these quarantines that are literally shutting down businesses and have been for some time now. And those types of quarantines and the reaction certainly leads to a lot less production. And of course, a lot less production leads to disruptions in the supply chain. So right now, you're seeing a lot of companies coming out, Apple, Microsoft, a number of them coming out and saying, hey, wait a minute, this thing is really starting to have an effect. And so consequently, it looks like our numbers are not going to hit what we thought. So we're seeing some warnings of what might be the revenue misses or the profit misses for this first quarter. And so what that's doing, obviously, as we saw in the market, just a terrible week in the markets this past week. What we saw in the market then was the reaction to that. Layer on top of that the fact that the Chinese economy was already growing at its slowest growth rate in 30 years and still sort of reeling from the effects of the trade war. Let's not forget about that, because that trade war had a much harsher economic impact on China than it did us. So you put all of that together, then you put this loss of production, disruption in the supply chain, and you wind up having what we believe is a pretty fair concern that you cannot ignore in terms of its economic impact. The question really is this virus going to be the trigger, if you will, that sends the economy, the US economy, the global economy, into a contraction phase, into a recession phase? And frankly, the answer to that, maybe. Who knows? There's a lot of information out there. There's a lot of information flowing out there. I think some of it is getting fanned by the media, creating much more of a hysterical nature to the story than perhaps it's warranted, particularly when you stop to think about the comparative numbers of just the regular run-of-the-mill flu, right? I mean, during the course of any year here in the US, there's approximately 30 to 45 million cases of the run-of-the-mill flu. Of that, there's about 30,000 deaths per year from the flu in this country. So our best advice that we gave our clients this past week is, don't worry about coronavirus. Make sure that you're not going to get the flu this flu season, because that's killed a lot more people over the course of this flu season than anything that the coronavirus has done. So our best advice is to wash your hands and get your flu shot. But the reality is, though, that this one and the reaction that folks are having in terms of the quarantines, in terms of the reactions, is a very strong reaction that could very well have some significant economic implications. And it's kind of odd, I guess, in a way, to see the reactions that are happening out there. Because if you look at other diseases like an Ebola or even a Zika, or I think another analogy to the current situation could be SARS, if you look at what happened with those diseases, the mortality rates, like on SARS, the mortality rates on SARS was like 10%. And obviously the data is ongoing with respect to coronavirus, but you're looking at a 2 or 3% death rate on a mortality rate on coronavirus. Now, obviously, that's not great by any stretch of the imagination. And if you contrast that with the run-of-the-mill flu, then the mortality rates there are far less than 1%. So obviously, coronavirus relative to the regular flu is a much more deadly strain of a virus. But at the end of the day, it's not really even approaching some of the other epidemics that we've seen over the course of the past 20 years, SARS being a pretty good example. What's different this time a little bit is that with SARS, there wasn't this impact on the economy per se. What's happening, over the course of the past 20 years, I mean, you look at SARS, that was 2002, 2003, and obviously over the course of the past 18 years, the world has become much more interdependent. The global supply chains have become much more connected. And so consequently, what happens there now is that you have much more of an economic ripple than perhaps you had 17 or 18 years ago. We still think that ultimately the economy will experience a very similar pattern, if you will, to what you saw with SARS, in the form of sort of a V-shape reaction in the economy. So the V, obviously the leading edge of the V is when you have the outbreak and the corresponding economic effect. That's sort of what we're in the middle of right now. And so obviously there's a market reaction. And then at some point, much like SARS did, it just sort of stopped and it ended and life went on. And by the way, there's, SARS, there hasn't been a case of that since 2003. But yet there's no cure for that either. So these diseases certainly surface and then sort of go back down. And so when you look at that from an economic perspective, once you sort of get to that turning point, then you have a lot of pent-up demand that also then comes back in the economy. And that's why you kind of have the backside of the V in terms of what it looks like for the economy. Another very interesting point on this one is that you're seeing a lot of response by the central banks around the world. And we'll talk about what that means, along with some other thoughts on the virus, the markets, and the week that was here on Dollars and Cents with Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back, ladies and gentlemen, to the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning. Of course, this week on the program, we're talking a lot about the coronavirus and the markets this past week. Just an absolute, complete, and total sell-off in the markets. If you check your portfolio on a weekly basis versus last week, boy, you're going to need some Pepto-Bismol no doubt about it, because the markets clearly had a pretty strong reaction to the virus and the news stories surrounding it. We were talking in the prior segment about what we see as sort of the economic pattern, certainly drawing some parallels to other outbreaks like your SARS, your Ebola, your Zika, things like that, and ultimately also helping to provide a little perspective on the situation. The reality is that 30,000 people per year in this country die from the run-of-the-mill ordinary flu. So, if you're spending time worrying about coronavirus and how it may affect your health, let me make a suggestion. Wash your hands and go get your flu shot, because that has the potential of being far more deadly. The run-of-the-mill ordinary flu has a potential of being far more deadly to you than this thing. So let's get some perspective on this. What's different a little bit this time is certainly the economic impact. SARS of 18 years ago, global supply chains were not as interrelated a part of the global economy as they are today. We cannot ignore that. We cannot ignore the economic implications that the quarantines and the disruptions in production and supply chains have, particularly in China, where they were already experiencing some economic weakness post-trade war with the US during the course of last year. So, here's the thing, though, when we talk about that V-shaped economic impact that you typically see with these types of headline events, whereby the leading edge, the reaction, the event, as it's still playing out, creates a decline in the economy, a decline in the markets, and then at some point you have some kind of an event that happens that turns it, and ultimately that then unleashes economic demand, that pent-up demand that was there that wasn't able to sort of be used during the course of the decline now comes back into full force. And so you typically see an acceleration in economic growth sort of after the effect, hence the V pattern, if you will, in the economy, which I suspect will be certainly how this type of an event plays out. When does the point on that V happen that turns this thing around? Well, folks, nobody knows that. The reality is, though, that history has a pretty good pattern of showing that that point does occur and things return ultimately back to normal. Wish I could tell you when that's going to happen, but of course we can't. What the other piece, though, that's a little bit different that does help to offset this economic impact is that a lot of the central banks around the world are really doing whatever they can to boost liquidity, to get money, to get cash into the economic systems that they govern. And ultimately, that helps stabilize the economy. Anytime you go through quantitative easing, you lower interest rates, you do any of those types of activities, ultimately you help the overall economy by making money more available. And it's certainly what they're doing over in China, the Central Bank of China, certainly engaging in that. And what that does is anytime you make fiscal policy easier is ultimately you do wind up unleashing more economic growth. So we suspect that the backside of the V will show to be much stronger than what the front side of the V, what the decline part of this event occurred. Then you've got the backside that we suspect will be even stronger because of the fiscal stimulus that has been into play. So here's the reality, though. Okay, and here's what we said to our clients this past week when we reached out to them with a communication on Wednesday to help give some perspective on it. I'm going to tell you a fact. And this fact has been going on for 100 years. And here it is. Every expansion in the economy is followed by a recession. Every recession in the economy is followed by an expansion. Stop and think about that, right? I mean, that's been the economic pattern. You can't have one without the other. That's been the pattern for well over the past 100 years. Periods of contraction, periods of expansion. They follow each other. And one of the biggest headlines that the folks in the media have been talking about is how long the current economic expansion has been going on. It's like we've heard that story every day for the past several years. And finally, maybe now, the folks in the media are getting their wish come true, because the folks in the media always love a bad story over a good, right? Because bad stories lead to fear. Fear leads to people paying attention more. And if you pay attention more, remember, the media, they're in the business of advertising. That means that they can charge more for their ads because, hey, we've got more people listening because we're scaring the you-know-what out of them. And so we can charge more for our ads. Well, the reality is that the pattern of the economy over the course of the past post-2008, 2009 period, it really has been a pretty long expansion. And at some point, okay, that expansionary period ends. And then you have your period of contraction, you have your period of recession. And the question is this the event? Is coronavirus and the effect that it's having in the global economy the event that somehow sort of pushes the transition from expansion to contraction, from growth to recession? Is that somehow the event? And I guess the answer is, frankly, maybe. The reality is, though, that that's the normal pattern in the markets and the economy as a whole. And so one of the things that we said to our clients, just for perspective purposes, is, look, if the pattern holds over the course of the next 30 years, you're going to see no less than 3 recessions and 3 expansions. And it's going to go, well, we're currently still in an expansion. So it's going to go recession, expansion, recession, expansion, recession, expansion. I can predict the future. See, I just did, because that's the pattern. Expansions always follow recessions, and recessions always follow expansions. It's the way it is. That's the cycle. Here's the reality, as we reminded our clients and we're reminding our listeners on the program today. If you have been an investor for the past 30 years, much like many of our clients, you have in fact experienced exactly that. 3 recessions and 3 expansions. The recessions, 1992, 2001, 2008. Everything else is an expansionary period of time. Seems to me like that's a pretty good pattern that you want to be taking advantage of as it relates to your investments and your retirement. So what's going to happen over the next 30 years? Recession, expansion, recession, expansion, recession, expansion. There you go. Problem solved. Because that's what we've seen over the past 30. But shoot, we've seen that over the past 100. These are the natural cycles of the market. Is coronavirus the thing that becomes the tipping point, becomes the thing that sort of pushes us out of one cycle and into the next? Who knows? Maybe. The reality is, though, that something's going to do that, because that's the natural pattern. It doesn't mean that you completely forget everything that has anything to do with investing. Because if you've been an investor for the past 30 years, you've seen 3 recessions and 3 expansions. If you've been an investor consistently, though, over that past 30 years, you've had a pretty darn good return. So don't forget about that. And don't forget about that, particularly in periods of times like this. We'll take a break. When we come back, we will continue the conversation here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning News Radio, WFLA Orlando. Welcome back, ladies and gentlemen, to the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning. Talking, of course, this week on the program about the coronavirus, the effects on the market. Obviously, terrible week for the markets. We've talked a lot about the virus, the economic impact, what we see playing out in terms of sort of that V-shaped pattern in the economy. Also, last segment of the program, we were simply reminding people of the economic cycle, right? Expansions are always followed by recessions. Recessions are always followed by expansions. That's the pattern. And ultimately, is coronavirus the thing that sort of drives it in? I mean, we hear all the media saying, oh, this expansion has been going on a long time and the market's been going up and it's been a long time since 2008, 2009, the last recession, and so on and so on and so forth. And is this the event that serves as the tipping point? Frankly, maybe, who knows? The reality is, though, that's normal. This is not anything to say, I'm out, I'm done, I'm going to completely change my investment allocation. Because here's the reality. If you've been a client of our firm for the past 30 years, and many of you have been, or if you've just simply been an investor that has been consistent over the course of the past 30 years, you've seen 3 recessions, 90, 91, 92, right? 2001, 2008, 2009. I mean, you've seen 3 recessions, but the rest of the time has been an expansionary period. If you look at your turnover that period of time, it's been pretty darn good. So like high single digits, low double digits, that's pretty good. So at the end of the day, perhaps we all need to put a little perspective on this. Unfortunately, that's not what the mainstream media is all about. So we would urge you to do a couple of things with this news story. First of all, get your flu shot. Wash your hands, get your flu shot, right? Because the run-of-the-mill flu kills like 30,000 people a year in this country. So do that, number one. And number two, maybe not quite listen to the media quite as much over the course of the next few days, because certainly they are really driving the pattern. So when we talk about that, okay, one of the things that we would also make some comments on is that not every recession looks like 2008. I think far too many people jump to the conclusion that whenever the next recession does occur, that, oh, it's going to be like 2008, I'm going to lose 50% of my money. That's not something that I really want to be involved in. And here's the reality. If you look back at this recession expansion and period of time, not all recessions are the same, not all expansions are the same. Well, that makes sense. And some recessions are mild and some recessions are deep. 2008, 2009, I think we can safely say that was a pretty deep one, which also typically means that the next one is not that deep, because the washout in 08, 09 in the economic system was much, much greater. And so consequently, that means it's just less to sort of wash out, if you will. By that, I mean, you don't see the kind of asset bubbles that you saw back in that time period, think real estate. You also don't see the ease of lending standards like you did back in those days as well. Certainly, it's a little bit easier to borrow money, and certainly home values have appreciated some, but as you recall, the radio show that we did with Dr. Sean Snaith of the Institute of Economic Forecasting out at UCF, we did that show with him about a month ago now. We talked about sort of the relativity of where those numbers are, and we are a long ways below where that acceleration happened in terms of housing and pricing and lending. So a little perspective, as we like to say, goes a long ways, and so certainly these times are good for that. So when you think of that, and you think of the absence of any real asset bubble per se, particularly in terms of historical standards, and you think about the relatively tighter lending standards, and then you look at low interest rates, low unemployment, and from an economic perspective, when you do go into that period of contraction, you're going into it in a much better economic shape, a much truer economic shape, a lot of cash sitting out there. And so consequently, then those types of periods of contractions don't really, or aren't really as deep or as dramatic as other types of recessions that you can get, like a 2008, 2009. So just some perspective as well on what we see just generally in the economy and the economic conditions. Not all recessions are like 2008. Many of them are mild in nature, and we suspect that the next one, when it happens, not if, when it happens, and is coronavirus the thing that makes it happen? Who knows? The reality is, though, that we suspect that that next one will be somewhat mild, particularly in comparison to what you saw in 2008. Stay tuned for all of that, right? We'll still be here doing the program through the next recession, the next expansion, the next recession, the next expansion, well, at some point I'll be old, but anyway, you get the idea. So the reality is, though, from an investing perspective, what do you want to do? You want to do the same thing that you always do, which is be diversified and be consistent. Now, by diversification, we mean make sure that you are well balanced. Make sure that there is a good balance. And this is a theme we've been talking about on this program for a couple of years now. Make sure that there's a good balance between growth and value, because growth has really been what's driving the market an awful lot over the course of the past couple of years. But dividends or value paying types of companies generally hang up better in tougher economic periods of time. And because they pay that dividend, you wind up getting at least some baseline level of return on a regular basis. So when we talk about being diversified, make sure it's not, oh, I got a bunch of stocks, okay? That's not enough. You got to drill down a little bit more into that and look at the actual mix of the types of companies that you have. The reality is that large companies have a tendency to have less volatility than smaller companies. So check that. That's number one. How much large do I have? How companies do I have, and how much in small companies do I have? You want to reduce the risk and volatility of your portfolio. Make sure you've got predominantly large companies in there. That's number one. Number two, make sure that you've got that mix between growth versus value. You should be able to look at your portfolio and see exactly what that mix is, exactly what the categorization is between growth versus value, and look at those numbers and look at those percentages and make sure that those numbers are somewhat even across the board. You don't want 50% in large growth and 10% in large value or large dividend paying. That would be a portfolio that has lost its diversification. So make sure you check that out. And then, of course, most importantly, remember, okay, we're all in this for the rest of our lives. We're not all spending the money all in one day, or you shouldn't be. And so consequently, remember to position those assets not just for today, tomorrow, next week, next month, next year, but for the rest of your life. And I think if you have that perspective, it'll help you get through tough periods of time like we just saw this past week in the market. So we're going to take a break. And then when we come back from the break, we'll reset. We'll talk a little taxes because, hey, it's that time of year, and give you some perspective on the winners and the losers from the tax cut that happened a couple of years ago. Got some data out on that now, and it's starting to be a little bit clearer as to which side of the table people were on. So we'll cover all of that. We'll try and get all of that in that last segment here on the program on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back, ladies and gentlemen, to the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning. One last thought. I said before the break, that was my final thought. We're going to move on. I got one last thought. One last thought on coronavirus, the markets that were this past week. Hey, if you've got some extra cash kind of laying around and it's not cash that you need in the short term, next year or two or so, might be a good time to take advantage of the sale in the market and go out shopping, right? I mean, you walk into Target, you walk into TJ Maxx, you buy all that stuff that's on sale and you get excited about that. Hope you shared some of that excitement and enthusiasm for when that happens in the market, right? Because got a great opportunity to get some great companies at a much lower price today than they were just a couple of weeks ago. Something to think about on that. So we'll shift some gears a little bit in this segment of the program as promised. Talk a little bit about taxes, right? I mean, it's the middle of tax season. Taxes are on people's mind. We always like to kind of include a tax topic in the show during this time of year. So we thought it would be good to kind of take a look at sort of a winners and losers kind of thing on the Tax Cut and Jobs Act that passed a couple of years ago. And there's definitely a disconnect between perception and reality. Boy, isn't that always the case, right? A lot of what we were talking about on the program about this virus stuff, particularly comparing it to the normal flu numbers in this country, little perspective goes a long way. There's always a little bit of a disconnect between perception and reality. Here's the latest out of a survey, and this is, of course, perception, because it's a survey, so it's what people think. And this is a New York Times survey. Only 40% of Americans believed that they got a tax cut under the Tax Cut and Jobs Act, and only 20% were certain they got a tax cut. A large minority believed that their taxes had actually gone up. That's perception, okay? Perception. Survey results. Here's the reality. Okay, the actual numbers based upon the actual returns. 65% of households got a tax cut. 65%, so nearly 2/3. Only 6%, so like 1 in 20, 6% paid more, and the rest there was no change. That disconnect of reality versus perception actually occurred at all income levels. So you might be thinking, well, folks at lower income levels might think, well, I didn't really get much of a tax cut, versus those in high income levels. Well, yeah, those guys probably, yeah, they certainly believe they got a tax cut. No, the disconnect between perception versus reality was consistent across income levels. Part of why that happened is there was a little bit of a problem with the tax withholding tables in that first year of 2018, right? So the Tax Cut and Jobs Act passed at the very tail end of 2017. It affected 18 taxes. It affected the 19 taxes. This is the second year where there's been the impact under the new tax changes. So what happened in 18, though, was that the withholding tables were shifted, perhaps shifted a little bit too much, in that they gave you more of your money along the way during the course of the year in your paycheck. But then when it came time to file your taxes, you had a little bit of surprise. Maybe you were expecting a refund because that was the prior pattern. You didn't get that refund because the money had been distributed to you along the way. So unfortunately, though, that, of course, disappointed people. Most people were like, well, I don't recall seeing the extra $10 in the paycheck. I just like seeing the $500 refund at one shot. So what did the IRS do? They ultimately shifted the tax withholding tables more in the traditional line of thinking for 2019. So in 2019, that tax withholding and refund and those kinds of things, that they adjusted that. So this season, those tax refunds would be more in line with sort of expectations based upon prior patterns. So that's sort of where all of that is, and that disconnect versus reality, of reality versus perception, certainly pretty strong across the board. So now, when you look at winners and losers on this thing, okay, that's where you need to really kind of parse through the details. And of course, obviously, if you cut income tax rates, and you cut income tax rates across the board, even at the higher brackets down to the lower brackets, if all of those brackets fall, well, proportionately then, if you are a higher income taxpayer, well, you clearly benefited, right? I mean, because your big tax rate, your 39.5 went down to 35. Well, obviously that's a 4.5% savings. So those taxpayers certainly benefited. High tax state like a New York or a Connecticut with a high mortgage interest, maybe you didn't. Maybe you lost some as a result of the limitations that were put on the deductions. If you were previously hit with the alternative minimum tax, the AMT, chances are you came out a winner on this thing, because you will find yourself, for the most part, now exempt from AMT. AMT still exists, but it was changed under the Tax Cut and Jobs Act to really catch a lot less people than it was catching. So if you had been paying AMT, you're a winner on this one, because now you don't have to pay that at all. I mean, the thresholds on that have been increased most dramatically. Most younger, low and middle income families with kids also wound up being winners on this thing because they benefited from the child tax credit going up from $1,000 to $2,000. So that was a bit of a benefit. And then also having the standard deduction double. So again, low middle income families with kids, those are big benefits. Jumping the standard deduction and doubling the child tax credit wound up making them more the winners on the equation. And then, of course, the self-employed, right? We've talked about the qualified business income deduction that allows you to deduct 20% of your profit as an additional deduction on your taxes. And so certainly for those that are self-employed or have a business, then you wound up getting a little bit of a savings there. So those are kind of the winners. In terms of the impact on the economy, I think when you look at the numbers, it certainly gave the economy a bit of a jolt, particularly during the course of the back half of 18 and 19, as those tax cuts work their way into the system. The corporate tax rates going down, the depreciation write-offs, the repatriation, all of that wound up being some positive developments for the economy. Even the lowest paid workers were experiencing higher median wage growth than workers overall for the past few years. So all in all, not too bad. Now, impact on the stock market, again, putting this past week aside, obviously pretty interesting. Here's a fascinating statistic. Here's the most fascinating statistic about this whole winners and losers assessment under the Tax Cut and Jobs Act. The impact on the budget, the impact on the budget deficit. And here are numbers that are going to surprise you. What is interesting is that under the Tax Cut and Jobs Act, the receipts for fiscal year 2019 were actually up by nearly 4% over the prior fiscal year. Wait a minute, how can that happen? We cut taxes and receipts by the government increased by 4%. I didn't think that was supposed to happen, and many economists and the media certainly were saying there's no way that's going to happen because you're just going to run up the deficit. But here's what happens. When you lower taxes, it changes behavior. It means that people are going to do things that they might not otherwise do. Clearest example of that is corporations spending money for hard items that then ultimately bringing that cash back from outside this country, paying the repatriation tax. Some interesting numbers on that. So why did the deficit go up? Well, the deficit went up because during that period of time, the spending went up by about $600 billion. So even though tax revenues went up by almost $200 billion, spending went up by $600 billion, and so therein lies the problem. That, folks, is the real problem. And unfortunately, in this political season, nobody's talking about that. And the reality is they probably should, because that's where the real problem lays with government these days, is the expenditures are way out of control versus what they were in each of the previous years. Anyway, we will wrap it on up and get on out of here. Thanks for listening to the show. Hang in there. Remember, get your flu shot, wash your hands, and don't get too terribly excited over this headlines involving coronavirus. We'll be back with more next week here on the program Dollars and Cents with your host, Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando.